I'd like to speak with the analyst who seems to have stumbled across this mess.
Certainly. That would be Peter Sullivan, right here.
Oh, Mr. Sullivan, you're here. Good morning. Maybe you could tell me what you think is going on here. And please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
You're back. Actually, you are back. You are still watching Funds Economics in the exploration, both of the EY reference book, which you somehow see there in the back. At least a small part of it. But it is there. As you can see, it's not just cut there and the rest is not existing anymore. But you never know, therefore I tell you. Well, the topic now, today, or whatever time, is major at least at this slide, is major holdings and control over portfolio companies and issuers. Well, how is the situation in this situation that a fund, for example, owns 70% of Adidas? Well, would be an interesting situation, but whatever company. So can they just do whatever they want? Do they have to tell that anyone? How's the situation? So I created, of course, an example to make it more plastic for you. And we do have the AIFX, which is the Alternative Investment Fund, of course. And then we do have the AIFMA, which is the AIFM of AIFX, which makes sense. And then we do have a company F, which is located in Vietnam. Well, why is it located there? Because I wanted it. I wanted that it is located in Vietnam. No, I mean, for example, there are a lot of industries which are having businesses in Vietnam or buying businesses in Vietnam. Textile industry, for example, whatever. Just imagine something. You have a creativity, so just imagine a company, a situation that fits. Excuse me. Okay, but with creativity, you won't get what GDVC is. The GDVC is the General Department of Vietnam Customs. Even me, I forgot it, but luckily I have it written down here next to me. So this is actually, it's the Department of Customs. It's the department where you have to address everything that is related to a company. If you want to found a company in Vietnam, go to the GDVC. You can do it under various other requirements. All right, so that is the situation. And now, how does that actually work? That was actually the question that I asked myself right now, and then I forgot that actually there's this question mark coming up to symbolize that I asked myself that as well. So how is it working then? In terms of course, not that these things just coexist with each other, because that is quite clear that they coexist. But what if the AIFX wants to buy the company F, or they want to buy like 30% of shares of company F, because maybe they want to integrate it into their supply chain, whatever. And well, how is it working? What is to consider? First of all, in the example, the share class C USD distribution is the one which will buy the shares. That has a strategic interest behind it, which we won't consider now because it's just an example. And then, of course, the portfolio of the share class C USD distribution needs to buy these shares, so to say. It will be included in this very portfolio. All right, so what happens now? The AIFMA will manage all that, of course. I mean, of course, the fund itself, the AIF itself, is not able to decide to buy the company. No, that needs to be done by the AIFM. That should be clear by now. And in the example, they want to buy 50% of shares. They can do so. And how exactly they are doing that? So company F is having a board of directors in that case, because the structure, don't ask me now for company structures in Vietnam, but the company structure in this example, the company F has a board of directors. Well, and this board of directors, of course, is responsible for informing employees how it is usually the responsibility of a board of directors in case there are some adjustments or whatever that needs to be directed to the employees. For example, if they decide to put a shift on Saturday, maybe they should inform the employees before. All right, so now the AIFMA goes to a lawyer, of course, and the lawyer then goes to the GDVC, informs the GDVC in Vietnam, but this can be also done by, where's my laser pointer here? Somewhere here it is, there. This is one option. The other option is that actually AIFMA is, so the manager is talking to the company, with the board of directors, and they are then by law actually responsible to inform the GDVC. But depending on the jurisdiction and on the treaties they may have, the countries which are included in the investment, so to say, this can be also the case that the manager themselves have to be in contact with the institutions there, with the supervision institution, in that case the GDVC. So, but actually, mainly this is up to the company F. This is the usual version, but it can be also that version. So, of course, they cannot just do that and not inform the investors of AIFX, of the fund, because the investors have a right to know these kind of things, which I explained, I think. The rights of investors in these terms was explained already in one of the videos before, and this was included there. So they need to state that in a short notice to the investors. All right. And what must be included in the note or disclosed in the note are, of course, the intentions, that is relating to the investment strategy, and the goal, so to say, how it fits into the goal of the investment strategy, and the intention also what to do with the company. What for? For example, if that is an integration of a I don't know, maybe a horizontal, not maybe a backward integration or something. How was it called? A kind of vertical integration, then of course this needs to be mentioned in the intentions. Maybe, for example, saving some costs thereby. Well, financing information. How do they finance actually to buy this company, or to buy 50% of shares in the example here? How do they do that? Do they leverage that? Do they pay it from whatever? Well, no, they cannot. Maybe they can even hold in the distributions to buy that, but then this is another thing. Well, just memorize, or just have in mind. Don't memorize it. You won't memorize it anyways. that the financing information must be disclosed. And then, of course, the information must be made available to the employees, of course. And actually, this responsibility is up to the managers. So, well, of course, then if the managers inform the board of directors, actually, then this is all they need to do. But depending on, well, I mean, actually, yes, that is where it ends, the responsibility. But and here, from here to here, it is not the responsibility. But actually, it is, because if the board of directors, for whatever reason, don't tell that to or don't make it public, or don't clear it, explain it to the employees, still the management is responsible therefore. All right, what else needs to be disclosed? Oh well, here's also the information that this note must disclose ownership thresholds in terms, like 10, 20, 30, 40, 50, 75. So from 10 to 50 in 10 steps, like in 10 times steps, 10% steps, that's the word I'm looking for, and then just 75, the next one, right? In these situations, the investors need to disclose the informations given already, but additionally, of course, there are some more. Also, the identity of the AIFM and the AIF must be disclosed to the employees. A policy of conflict of interest must be, of course, disclosed. Well, that's clear. I mean, there's nothing I need to explain, I guess. And also the policy of external internal communication must be disclosed then for the employees, because, well, maybe something changes due to that integration, in terms, in the example that we have an integration here, a backward integration. I think that's a term, but you know what I mean, like when the producer gets integrated into the supply chain by just buying actually the producing company. This is what I mean there. Is it backward integration? Is it vertical integration? Backward vertical integration? I don't know. Maybe you know. That's good for you. Then you can write it in the comments. Actually, nobody is typing anything in the comments. Just it's really rare that happens. Maybe one day will be different. We will see. Well, so these are the things to consider when we are dealing with requirements, regulations about the major holdings and the control over portfolio. Excuse me. Companies and issuers. That's all that you have to know. Just have in mind. Just remember that how do you call that? That scheme. Yeah, that scheme. Just how it is. Like, just remember, the manager needs to inform the company and needs to make sure that the employees know some stuff, like who are they, new policy of interest, conflict of interests, of course, and then the internal external communication. And to the investors, they need also to be informed. Need to drink some coffee, maybe. Of course, not water, only coffee. Intentions in terms of the investment strategy, financing information, where's the money coming from, and then make the information available for the employees. Just have that in mind. And, well, of course, also the thresholds. If it's just 4%, nobody needs to know. But if it is 10, if it is over 10, always a note must be disclosed. Yes, that's actually it. with the major holdings and control of our portfolio companies. The next thing we will have a look at is EuVECAs and EuSEFs. Also an interesting topic. All right, so so we can finish with this slide. It is over. I don't have to talk anymore. So let's continue with the next one. So here we are at the next slide, dealing with the EuVECA. I don't know. Pronounce it however you want, or just don't use the abbreviation and just call it the European Venture Capital Funds, which is actually the real name. I mean, the other one is also the real name, just the abbreviation. And me, I actually found something to drink. Water, of course. All right, so let's have a look. What is applicable when we are dealing with a EuVECA, or with the European Venture Capital Fund? So, first of all, the investment structure implies or is defined by 70% qualifying investment. So what the heck? What is the qualifying investment of a EuVECA? And what is a regular investment? Well, the regular investment is everything else than the qualifying investment. Therefore, we should know what is the qualifying investment and not the other way around. Would be more complicated. So 30% is regular and then 70% qualifying investment. So we need to find out what actually is the qualifying investment, and therefore we do have this nice small chart here. Qualifying investment is two things which are basically the same, quasi the same. One time it is an equity instrument, regular equity, and the other time it is a quasi equity instrument, therefore quasi. And actually for both is applicable that one time, and where's the laser pointer? Always gone. Here. One time it must be required directly by the EuVECA from the qualifying portfolio undertaking. So now comes a new thing, the qualifying portfolio undertaking. I will explain that in a second. And may include loans to a qualified portfolio undertaking. Yeah, here we have it again. Of another EuVECA that already is holding qualifying investments, well, up to 30%. So this is actually important, 30%. Yes. Beneath all the 20% rules, we now have again another 30%. May not exceed 30%. Okay, first of all, what is a quasi-equity instrument? That is actually explained in the EU 345/2013, which is the, how is it called? Directive, the directive which explains everything about the European venture capital funds. Of course, then also what is a quasi-equity instrument? A quasi-equity instrument is something we know already, but not in that circumstance. But for example, convertible bonds would be considered a quasi-equity instrument, but actually, yeah, well, in these terms, not bonds, but debt, for example. So it could be convertible debt, which is able to convert at a special time. Usually then it's the same structure than the convertible bond for a slight bonus or a big bonus, depending on. But why we don't just have a look, I think, is it the next one? Yes, I have it also here. This is Article 16 or paragraph 16 of the EU 345/2013. There it is stated, qualifying investments should be in the form of equity or quasi-equity instruments. Quasi-equity instruments comprise a type of financing instrument which is a combination of equity and debt, where the return on the instrument is linked to the profit or loss of the qualifying portfolio undertaking. Yeah, we still have to know what that is. And where the repayment of the instrument in the event of default is not fully secured. Such instruments include a variety of financing instruments such as subordinated loans, silent participations, and participating loans, profit participating rights, convertible bonds. Actually, convertible bonds are qualifying as quasi-equity instruments, and bonds with warrants. Well, and of course, also, if you want, you can just look it up. Then there are more of these instruments listed. These were just the most common and the most easy instruments, so to say. Easy to understand, easy from the structure is actually meant. Yes, so this is actually it. But here in this term, this is not it. I will explain the rest at the moment. Just now we know, okay, what is a quasi-equity instrument? And here in this part here, from the qualifying portfolio undertaking, or it can be as well as securitization. No, it can be in an exchange. It can be in exchange for an equity security issued by a qualifying portfolio undertaking. So not only from the qualifying portfolio undertaking itself, but also as an exchange for an equity security. So these two things. Okay, let's put that aside. And anyway, quasi-equity, convertible debt, yes. Revenue-based financing, for example, is another thing, or preferred equity. Preferred equity is actually nothing else than when investors are provided with certain preferential rights, such as the right to receive dividends before common shareholders. That, for example, is a preferred equity. And now my earphones have no battery anymore, which of course is no problem for my flexible handling of the situation. And actually, this is a preferred equity. Revenue-based financing is known from many TV shows, for example, where people present their companies or their ideas and want to have like revenue-based financing, meaning the investor is I know the word in my language, but it does not bring anything. So it's anticipating in the revenue from the company, from the company. And now, actually, now that I mentioned that, from the company, what actually are the qualifying portfolio undertakings? And then are actually companies, and then are SMEs, so small and mid-sized entertainments I have in mind, but well, this is actually not the case. Small and mid-sized companies, SMEs. Small and mid-sized. In a flash, there will be the explanation and what it means, because as you see, you have a very forgettable host. Not forgettable. The thing is, I always produce these videos like in the night, and as you see, that's the result. Well, can acquire shares of an SME from first existing shareholders or other EuVECAs. This is also up to these points here, up to these 2 points. So how actually the the European Venture Capital Fund is able to acquire these shares, and first option from an SME is from existing shareholders, kind of an easy thing, and the other situation is from other EuVECAs. But in case they are getting the shares from other EuVECAs, this is only possible if the EuVECA they are getting it from are not investing more than 10% in other EuVECAs, and that's for diversification. I think I have it also here, yes. This is for diversification issues. So now we still need to know what actually is a qualifying portfolio undertaking. We know it is SMEs, but what the heck are SMEs? And this we find also in the 345/2013 directive. And here we go. Qualifying portfolio undertaking, meaning small and medium-sized enterprises. That's the word that I was looking for. What I was saying before, I forgot it. I even forgot that. So, well, okay. It is stated that a qualifying portfolio undertaking, which is actually a small and medium-sized enterprise, must be defined by the following bullet points here, by the following conditions, and they are: first, laser pointer here, they may not exceed the number of employees of 250, so then must be below that, and must not have a turnover more than 50 million. Otherwise, this here is an or, by the way, a logical or, it's not an and. Otherwise, if that's not the case here, then it must not exceed 43 million in the balance sheet. It must be in the EEA area, or otherwise it must not be in an NCCT. NCCT are countries which are, so to say, blacklisted, non-cooperative country and territory, that is made from the FATF, I think, financial advisory, so many abbreviations. In the end I will try, just for fun, to collect all the abbreviations and see how many they are. They were FATF, forgot it right now, but this is an institution, of course, from the US, which is deciding which countries are non-cooperative countries or territories. Well, yes, that's another thing. And then we do have the OECD Article 26 Model Tax Convention with the home member state. The OECD Article 26 Model Tax Convention is nothing too complex, but let's say it's a treaty, it's a tax treaty, so that's all. Otherwise, it's too much. So just remember, they have to have also this OECD Model Tax Convention in place. That's the word I was looking for. And of course, they must not be listed. Sure, because otherwise, then this would not make much sense. All right. So this is actually the situation for European venture capital funds. So remember, 30-70, 30% regular investment, 70% of the qualifying investment. Qualifying investment means also quasi-equity investments or equity investments, quasi-equities, convertible debt, stuff like that. And what actually is then the quasi-equity instruments, they are again required to be by a qualifying portfolio undertaking, which is an SME, and there are the applicable requirements or definitions, or requirements actually, for the SMEs are nailed down in the EU 345/2013, 2013. Well, yes, and I mean, it's quite clear. If it's a company that has like 5,000 employees, it won't be a qualifying portfolio undertaking. So it has to have, of course, the venture. I mean, like, it has to be a I forget today all the words. Maybe Alzheimer's is coming, but a startup. Startup, that's the word I'm looking for. Startup, a new company, a unicorn at best. Then it's a good investment. All right, so this is it about EuVECAs, and now we will have a look at the EuSEFs, and because both are actually mentioned here, so I have to, of course, explain also both. Now we are only having a look at the venture capital funds. And still, what are we actually doing here? We are having a look at the detailed rules of diversification. So what that has to do with diversification, that's not too difficult, because actually all that explains how to diversify the EuVECAs. Yeah, just to give you a context again, what we are actually looking at here, and well, we are looking at it under the point of detailed rules of the diversification rules. Of course, we do learn a lot of other stuff thereby, but that's actually the main course here. All right, so let's have a look at the EuSEFs in the next slide. All right, now we're dealing with the EuSEFs. What is a EuSEF? It's a European Social Entrepreneurship Fund, not to confuse with the name EuSEF. It reminds me of Yusuf, or Joseph, whatever. Just don't confuse it with that. All right. Let me begin with the 346/2013 directive to explain what actually is the sense of a EuSEF. In Article 1, increasingly, as investors also pursue social goals and are not only seeking financial returns, a social investment market has been emerging in the Union, comprising, in part, investment funds targeting social undertakings. Such investment funds provide funding to social undertakings that act as drivers of social change by offering innovative solutions to social problems, for example, by helping to tackle the social consequences of the financial crisis and by making a valuable contribution to meeting the objectives of the Europe 2020 strategy set out in the Commission communication of the 3rd March 2010 entitled Europe 2020, a strategy for delivering smart, sustainable and inclusive growth. One has to know that as stated or as mentioned before, this directive is from 2013. Yes, and this regulation, now the second paragraph or article, this regulation is part of the Social Business Initiative established by the Commission in its communication of 25 October 2011, entitled Social Business Initiative Creating a Favorable Climate for Social Enterprises, Key Stakeholders in the Social Economy and Innovation. Kind of a large entitlement from the Commission. Well, but now it should be clear what the European Social Entrepreneurship Fund is. Actually, these are funds which are mainly, not mainly, I mean, well, they are invested in SDGs. All right, enough with that. Let's have a look. The nice thing is, actually, there's not much difference to the EuVECAs. So, again, investment structure, 30% and regular investments and 70% qualifying investments. So what are the qualifying investments now? Well, again, equity instruments and quasi-equity instruments. So from the mechanic, it is not a different thing, but from the measurement, so to say, of course, it is a different thing, because in the one case we do deal with venture capital, so can be whatever company, can be a sneaker company producing new sneakers, and it in this case, and this could also be the case, that a sneaker venture capital business is considered to be a EUSEF, or considered to be a qualifying investment, thereby matching the qualifying portfolio undertaking for EUSEFs. Well, sometimes these sentence structures are really long. Well, but what is a good example for that? EUSEFs. Well, I mean, like social impact funds, like impact investment, generally are can be structured as EUSEFs. Of course, if they are based in Europe. Let's have first a closer look on what exactly is meant by sustainable and inclusive growth. So what are actually the the determinants of the entrepreneurship fund? Thereby, I think now just 346/2013 appeared, but now, yeah, there is. In Article 14 of the mentioned Directive 346, we have a closer or a better definition. So, social undertakings include a large range of undertakings taking various legal forms which provide social services or goods to vulnerable, marginalized, disadvantaged, or excluded persons. Such services include access to housing, healthcare, assistance for elderly or disabled persons, childcare, access to employment and training, as well as dependency management. Social undertakings also include undertakings that employ a method of production of goods or services which embodies their social objective, pardon me, but the activities of which be outside the realm of the provision of social goods or services. Those activities include social and professional integration by means of access to employment for people disadvantaged, in particular by insufficient qualifications or social or professional problems leading to exclusion and marginalization. Those activities may also concern environmental protection with a social impact, such as anti-pollution, recycling, and renewable energy. So now it is easier to get an example. I mean, to imagine an example, but we don't actually have to imagine an example. Now to have a look at, yeah, well, we still have to imagine an example, because what I think will come up next is the fund from Triodos Investment Management. This fund is a fund called Triodos Pioneer Impact Fund. I think it's quite well known. Here we do have the PRIPS, I mean, like PRIIPS, which is the, yeah, well, it's actually the new version of the KIDs, just with a little bit more, with a different structure. But they will be overworked soon for new SFDRS, coming soon in October, I think, of 2023. So here we do have a, where's the pointer? Here we do have a look at the PRIPS from the Triodos Pioneer Impact Fund. I don't know which which umbrella it is that we are having a look here right now. Well, actually, this is right now the coast part and the return part. Just to give you an idea, and also to have a practical example at hand, because I like to know, like, okay, someone's mentioning, yeah, there are European social entrepreneurship funds, and then you're like, oh, okay, That's good to know. But you never have an idea what they look like, or you don't have any example. Therefore, I like to include always some real life examples, so to say. And here we do have one real life example, and we see. I mean, I'm not making commercials for them, but they have a return. I mean, they calculate a return of 9% and then 7.4 after costs. That's still 2.4 more than current interest rates. All right, so that just as a real life example. And well, they then invest, I mean, these kind of funds, they invest then in the projects mentioned in the Article 14 of 346 2013. Well, that, for example, could be organizations that are in microfinance, or yeah, microfinance is quite a big one, I think, but also in infrastructure projects, like in Africa, for example. I do know about some management companies investing into these kind of projects. Well, and otherwise just look it up if you are interested in that. And well, so this was the example. What's the next thing? We will have a look at the, well, yeah, SFDRS, SFDR, which are the Sustainable Finance Disclosure Regulation from 2019, which that's the one I mentioned that will be overworked soon, confusing the whole market again. Yeah, well, because there's a lot of regulatory stuff in these things, and about the calculations, about the risk calculations, then also about ESG calculations, rating calculations, so to say, and so forth. But this will be topic of a own video, because this will make this video like extremely long, and it just don't fit into it. Just to have a basic overview, SFDRs are the ones which are, so to say, categorizing these European social entrepreneurship funds, for example. And they are structured by, there's Article 6, there's Article 8, there's Article 9. By the last line, like the last overworking of the SFDRs, many of the 9 ones were downgraded into 8 ones. So what are actually 6, 8, and 9? 6 is when they're, I mean, Article 6 of the SFDR, of the Sustainable Finance Disclosure Regulation, means, Article 6 means funds without a sustainability scope. Actually, no sustainability scope. Article 8, funds that promote environmental or social characteristics. That's the light green version, although we do have the dark green version. Like with the cars, you have everywhere these light systems. Light systems, how are they called? The light systems, yeah. Just have in mind light systems. And Article 9 then is the dark green, funds that have sustainable investment as their object. And these ones are actually right now really rare, because many of them got downgraded to Article 8 ones. Yes, so I think, what is the next thing? Okay, well, the categorization of these funds, as mentioned in 6, 8, and 9. Just mentioned 9. Just remember 9 is the best, so to say, and 8 is also good, and 6 is, so to say, 6 is another version of 0 in this case. All right. What is to mention as well? The EuSEFs managers need to employ the clear and transparent procedures of various things, and of measurement procedures. They need to have a clear and transparent measurement process, and they need to lay it down clear and transparent about the following points: employment and labor markets, standards and rights related to job quality, social inclusion and protection of particular groups, equal treatment, equal opportunities and non-discrimination, public health and safety, access and effects on social protection and on health and educational systems. Well, this is also required for EuSEF funds, and actually all the rest is the same. And now one may wonder, like, okay, yeah, like clear and transparent procedures, is that not like further stated, I mean, further defined? Actually, I am not aware of that. I am actually not aware of that, but I ask myself that right now. I was having a look while I was researching, did not find anything, but I was having a look into the PRIPs and into the reports, I mean the annual reports of some impact funds, and they do deliver quite a clear and transparent explanation of how they measure the impact, but they do have most of the time own grids, I mean like own calculations. So there's not a unifying system in place for that. Well, as I've seen it often, they refer much to employment rates, so especially about jobs which are created due to their investments in deprived areas. Deprived areas is a, I mean, like in developing countries or in third world countries. Yeah, well, that was one situation. I mean, there was one big measurement thing. Actually, also they calculated in some funds, I mean, some organizations calculated as well, like how many were still unemployed and how much the workforce is still, so to say, to get there, I mean, to make it efficient. That was one thing, but as well, the measurement of emissions was a thing. I mean, actually, everything that is stated here, and as well, the minorities which got into a better position due to investments. That was what I've seen often. Well, yes. If one is interested into that, there's actually a quite good summary and a quite good example of all that you can find in the DWM annual report. It's quite detailed, but as well in the Gaia, yeah, it's GAIA investment management or managers. It's Gaia funds. They also deliver a quite accurate explanation of how they do calculate their impact in terms of SDGs. Well, but as mentioned, this is a whole big topic on its own. SDGs, SFDR, that will be discussed in another video. Just now we know, okay, so if all that is taking place in Europe, there's a fund which only wants, excuse me, which only wants to invest into these kind of investments. Yeah, sometimes I lack words. Then it is mostly, it can be structured. It will be mostly a European Social Entrepreneurship Fund and will be structured as one, but it needs to meet these criteria in terms of the diversification as well as requirements. Yes, so this is it actually for the European Social Entrepreneurship Fund. So now we covered EuVECAs and EuSEFs in terms of detailed rules of diversification. We've had a look at some laws or some categorizing directives here, and know now in general how these are structured and diversified. So let's continue, I think, with the borrowing or lending, borrowing, lending, something like this. We will have a look at at that at the next slide. Yes, and here we are at the next slide, but actually not dealing with any what was it that I mentioned before? Borrowing, lending, none of that. But actually borrowing, yeah, well, in another under different circumstances we will also have a look at borrowing, but in terms of borrowing regarding ELTIFs. What are ELTIFs? European Social Entrepreneurship Funds. What is a European Social Entrepreneurship Fund? You may ask yourself now. I asked myself the same. And of course, who has the answer? We all know it already. It's of course a directive. So let's have a look at a directive, and of course at the right directive would be an idea. And it is, oh, actually it's the wrong way around. So it's 760/2015. That is the directive dealing with ELTIFs and giving all the has to look correct, has to be correct. The all the data, all the requirements, everything about ELTIF. So let's have a look. What do they state in the very beginning? So actually, again, to have a picture of what an ELTIF is. Number 1, Article 1.1, whatever. Long-term finance is a crucial enabling tool for putting European economy on a path of smart, sustainable, and inclusive growth. In accordance with the Europe 2020 strategy, which is kind of outdated right now, but high employment and competitiveness for building tomorrow's economy in a way that is less prone to systemic risks and is more resilient. European long-term investment funds (ELTIFs) provide finance of lasting duration to various infrastructure projects, unlisted companies, or listed small and medium-sized enterprises, SMEs, that issue equity or debt instruments for which there is no readily identifiable buyer. By proving finance to such projects, ELTIFs contribute to the financing of the Union's real economy and the implementation of its policies. Well, now that we have it already, we can just read the next one. Don't fall asleep, just listen to it. On the demand side, of course, consciously, attentively, on the demand side, ELTIFs can provide a steady income stream for pension administrators, insurance companies, foundations, municipalities, and other entities that face regular and recurrent liabilities and are seeking long-term returns within well-regulated structures. While providing less liquidity than investments in transferable securities, ELTIFs can provide a steady income stream for individual investors that rely on the regular cash flow that an ELTIF can produce. ELTIFs can also offer good opportunities for capital appreciation over time for those investors not receiving a steady income stream. Financing for projects as transport infrastructure, so the Silk Road, for example, sustainable energy generation or distribution, social infrastructure, housing or hospitals, to the rollout of new technologies and systems that reduce use of resources and energy, or the further growth of SMEs can be scarce. As the financial crisis has shown, complementing bank financing with a wider variety of financing sources that better mobilize capital markets could help tackle financing gaps. ELTIFs can play a crucial role in this respect and can also mobilize capital by attracting third country investors. Actually, reading that, I feel like I'm making commercial for the European Commission, but I'm not doing so. They just have kind of catchy writing style in their directives. All right, so now we know what an ELTIF is, a European Social Entrepreneurship Fund, and what they are for. Yeah. If you don't know, then you have to rewind and listen to it again. I won't summarize it now. All right. So after that, what is the investment structure? The good thing is, again, the same. So 70-30, like before, nothing new. But now about the 70% qualifying investment. But the qualifying investment here is actually to exchange not qualifying investment but eligible assets, because here in this fund structure, in this vehicle, in the ELTIFs, we are dealing with, we don't need qualifying investments, we need just eligible assets. And these eligible assets, we know what eligible assets are. They are diversified that way. So UCITS assets are 5%, may not exceed 5%. Single ELTIF, EuVECA, EuVECA, and EuSEFs, 10%. Real assets 10%, and single qualifying portfolio undertaking, so the ones we know from the EuVECAs from before and from the EuSEFs, may not exceed 10%. May exceed these 10% in certain cases, as we know already from before. Like with the money market funds, there were a lot of these exceptions. Yes, but I won't go into them right now, for it's not that urgent. And if you need to look up the specialties of under which circumstances that may exceed to 20%, not going over 40% in total, and then you have to look it up. It is on page 117, 118, I think, of the book behind me. Well, so this is about the diversification. And of course, have in mind that here is standing single, so it's 10% in a single one on the net asset values. What else is to mention in terms of the European Social Entrepreneurship Fund? Well, they are not allowed to, they are allowed to borrow. I wanted to say that the second or third point, but I will say it, of course, now when it will come up. So borrowing is allowed up to 30, may not exceed 30% of the capital, and investing in eligible the purpose of borrowing must be investing in eligible investment assets and not in anything else. So this is to remember about the ELTIFs. Then the next thing is the lifetime. While open-ended funds usually do not need to have a lifetime, closed-ended funds usually do have a lifetime. It's not completely necessary, but usually they have a lifetime, and it is stated in Article 44 of 76/2015 that the lifetime of an ELTIF may not exceed 10 years. Generally, of course, they are, as always, exceptions. That just also to mention. And now, that's the third point, actually, that I wanted to, that I said in the beginning, the first, you know what I mean? No short selling, no securities lending, borrowing, repos, and this is actually, the last point, like repos or similar things like reverse repos or anything that imitates synthetically a repo, or not synthetically, is generally not applicable, not allowed, but only in case if less than 10% of the fund's value is affected thereby by operations of that kind. Yeah, so it is actually possible, but in case that FDIs are used, they are only able to be used for hedging purposes of the ELTIFs, other investments. And that is actually stated not in the 76, but it is stated, or was it the 76? Because there's one directive. No, it was not the 76. It's in another. I should have looked it up. It's actually stated in another directive, which deals more with the investing structures and the use of FDIs in ELTIFs. I've read it before, but of course I forgot it. The actual directive number. But that is to mention that you won't find that in the 761, but you have to go into one that was published 2 or 3 years later. You have to look it up. I'm sorry. Yeah, sometimes some work is still up to you. All right. There is now, off topic, so to say, there is a large part in this chapter dealing again with MMIs. Also a question to you, why it is actually repetitive to what we know already about MMIs, because it's actually a very nice and structured summary of everything regarding diversification rules of MMIs, only that we have that already some pages prior to that. Therefore, it is not included right now again. And thereby, chapter 4 is done. After part, whatever that is, I think it's 6. Part 6 of part 3. I don't actually know how many parts the other parts have had. Well, but we're done. So we can continue with, finally, with part 5. I hope with chapter 5, excuse me. And this time I will guarantee you that the numeration will be accurately and more useful. All right. So that's it for today, for this session here, for this lecture. I hope you remember something of it somewhere when you need it, of course, and not in situations you don't need it. All right. Thanks a lot for watching. Recommend my channel. Yeah. No, you don't have to. It's fine. So see you in the next lecture. Thanks for watching.
Okay. Yeah.
Jesus fucking Christ.
Yeah.
What did we learn, Palmer?
I don't know, sir.
I don't fucking know either.